Nice, John Polemy here, Actionable Intelligence. Today is Saturday, September 20th, and this is the weekly market update. A disclaimer, anything that you hear or see in this podcast or video is not to be taken as investment advice. I'm not a registered financial advisor. I cannot give you individual investment advice. Anything that you hear or see here is for informational purposes only. Please do your own due diligence. It's your money. It's your responsibility. Okay, so, I've been talking now for a couple of years about the overvalued US stock market, specifically targeting AI, technology, all of these things. The parallels that I see today that match what I saw and experienced during the dot-com bubble, yet the market continues to go up. And so it's gone on a lot longer than I thought it was going to go on. And it may, in fact, go on even longer. All that means is that things are becoming more and more stretched on valuation. And at some point, there will be a reckoning. This is just, things can't go up forever. It's just not possible. We're not entering a new era. We've heard all of this talk before. I've went over it ad nauseum. I'm not going to go over it again. But one of the reasons why things continue to go higher is that you have this constant flow of money, okay, that's coming in because of the passive investment theme that's been going on for well over a decade, probably more. And what do I mean? Well, people don't do active stock picking anymore. What they do is via their 401k, I've seen like in 401k programs. Now, I never had this. I was fortunate. I just want to make a side note. I was fortunate that the 401k plans that I was in, they had self-directed. You could opt out of the menu of, you know, target funds and balance fund. They would have a target fund. Like if you're going to retire in 2050, then you just put money in there, and then the manager automatically balances between bonds and stocks, and based on how much longer you have to retirement, would have a uh, higher stock allocation because you're able to take more risks, this kind of thing. And so this is what a lot of people have. So they have their 288 a payday or whatever it is, $100 a payday and employer match going into these, Fidelity, Vanguard funds, what have you. And then these things are allocated basically mechanically. They go into index funds in the stock market, and whatever has the highest market cap dominates the index, and that's where the funds go. And so it's kind of a self-reinforcing mechanism. It's the same thing with ETFs. I think I showed the graph last week, but if I didn't, I think I put it on the Actionable Intelligence Alert Facebook page group, that the amount of ETFs now exceeds the actual number of listed stocks. That's insanity. And so people have just um, abdicated their financial decision making to bots, to managers, to the indexes. And so this helps keep things moving forward because things with the highest market cap absorb more of the incoming funds. And then they go up in value. People's juices get flowing. Hey, this is working. I'm getting wealthier. I'll keep doing this because it's working. And the thing about this is it works until it doesn't work. The same mechanism that caused it to go up like that will, when it eventually turns, which inevitably it will because valuations will get too stretched, it'll be the same thing on the downside. When people start pulling funds or transferring funds or moving out of these things when they go down, because people always chase performance. We know that. We've talked about that ad nauseum. That goes back even to, the vignette that I talked about, or the story about Peter Lynch and the Magellan Fund, that even though it was a top performing fund for almost a decade, most people invested in the fund lost money because why? They would always buy at the top and sell at the bottom. This is just how humans are. And so, of course, we don't follow that methodology at the Actionable Intelligence Alert newsletter. I have a lot of experience. I've been in many markets. I've learned many lessons. I have the battle scars. I've made a lot of mistakes that a lot of people haven't made. And also, I'm a student of market history, and I understand valuations, and I understand psychology, and I understand that human nature doesn't change. And so, applying these things to markets leads me to distill it down to basically the thesis or the mission statement of actionable intelligence, which is sell overvaluation and buy undervaluation. And so here's what we have here. I just wanted to show this kind of leading into this chart here. Share of passive ETFs and mutual funds. It's just been on a continual growth path. You see back here in January of 2012, share of passive ETFs um, that are passive was like 25%. And so in 13 years, it's basically more than doubled. And this is what has helped propel. It's not the only reason, but it's a big reason because it's directing this flow of liquidity into these passive funds, which are mostly indexes and or themes, and they just direct the money with no thinking into the largest market cap stocks, which causes them to have a bid and go up over time. And people chase performance. Hey, it's working. Look at all the money I've made. Look at it. I must be smart. I'm feeling good. I'm going to keep doing this because it's working. And so it's really that simple. The thing I would caution, as I've said before, and people like Mike Green have said, and Luke Groman and folks like this, people that are way smarter than me, when this eventually reverses, you get the same reverse flywheel effect. When the money starts coming out, guess what it's going to come out of? It's going to come out of these funds that are, basically have the money allocated to these large cap stocks that are popular, and who's going to buy them? Because that's what I saw. That's why, when we had the dot-com bust, the NASDAQ went down 80%. 80%. It didn't happen in a week or two or a month. It was a slow grind. If you haven't experienced that, if you haven't seen that, um, then it's difficult to explain, what that means. But I think that we're probably going to experience something again. Again, timing is always the issue. And I don't need to time it because there's plenty of opportunities around the world. I don't buy overvalued securities and investments. I buy things that are cheap because I know historically and via the research that's been done, which academic research has been done on this, the more that you pay for an asset, the higher you pay, the lower your potential future returns. And there are thresholds where if you overpay to a certain extent, then you're guaranteed it's almost 100%. I believe it's 100% certainty that over the ensuing 10 years, subsequent 10 years, you have a negative return because what happens is if you buy it in inflated uh, market caps or things that are extremely overvalued, all of the future gains, all of the um, everything's already baked in. Okay, everybody's already looking ahead and extrapolating out the current performance of a company or a theme or sector well into the future, and they're pricing in all of that. So if anything goes wrong, if it disappoints in any way, you get the big tumbles, and that's how you get the big drawdowns, which lead to underperformance. So again, um, this information's out there, but a lot of people, that are inexperienced or don't understand these things or haven't experienced them, it's hard to communicate to them. So this is why I always go and try to buy things that are undervalued because the research also shows that when you underpay for assets, when you pay less than they're worth, typically over time, you do fairly well. And when you expand your investing universe into the entire globe, well, then your opportunity set just becomes very large. And I think this is something that a lot of people in the West, in particular in the US, suffer from, which is home country bias. They're homers. That's fine. A lot of them don't have experience or the ability to understand how to invest outside the United States. It's getting easier and easier with the ubiquity of the internet and platforms that allow you to do that. So there's no reason not to take advantage of that, in my view. So this is one of my favorite indicators for valuation, which is the CAPE ratio, cyclically adjusted PE ratio. And it shows you that typically when you get to inflated or high cyclically adjusted PEs, usually, which indicates overvaluation, you then go through periods of correction. You can see that going back to the 1930s. You can see that in the 70s, during the Nifty 50 craze, when it bottomed in 1980, the cyclically adjusted PE ratio was 7.5. I mean, this is historically cheap. I remember that. Then you see the subsequent bull market up to the tech bubble, where you got well over close to 45 cyclically adjusted PE. You see the correction down to 15, uh, and then the current run. And what we have seen is that when you have a earnings cyclically adjusted earnings ratio, when you hit like 37.5, this is typically when you're guaranteed 100% to have negative returns over the subsequent 10 years. Again, this time might be different, but probability suggest, if you look at the history, probability suggest that how do you want to make your bet? Do you want to bet against history? Do you want to bet against what has happened in the past? It's like, okay, you're at a poker table, you're dealt a certain hand. We know from probabilities that if the hand is played 10,000 times, how it will typically play out if you play it correctly. And so there's times to push, there's times not to push. And I don't, I look at the probabilities, I look at history, and it serves me well. Just because it's easy to say, well, it hasn't happened yet. Okay. And you can be that guy that's sitting on the gallows with the rope around your neck with no idea when the trap door is going to open. But again, eventually it will open. Is it going to be in a minute? Is it going to be in 5 minutes? Is it going to be in 6 months? Is it going to be in 6 years? It's just so much easier to buy things that are cheap and that have an ability to become, things, stories that go from bad to less bad and then get revalued. Those are so much easier. And what's interesting is I can buy a lot of cheap things that are real businesses that pay me to own them. They pay dividends, they're buying back stock. Why wouldn't I want to do that? That's the whole point of investing, is to get a return on my investment. Again, as I've said many times before, and I won't belabor the point, a lot of people confuse, I believe, investing with speculating. I'm going to buy this stock, I'm going to buy this security, and the reason I'm going to buy it is because I think it's going to go higher and some other greater fool will pay more for it. That's speculating, which is fine. Speculation is fine. Jesse Livermore was a speculator. He did very well. He ended up blowing his brains out after he went bankrupt in the Depression and the crash, but that's a whole nother story. But what I'm trying to tell you is if you understand that you're not investing and you're speculating, then that changes your mentality. People confuse the fact that they are speculating with investing and they don't know that they're speculating. And this is dangerous. So I like point these things out. The problem with a CAPE ratio is it's not a timing tool. Okay. It doesn't tell you, okay, well, you've hit 37.5. Within 6 months, this market will drop. It's not good at doing that. The problem is that we have a lot of stuff going on in the market. We have a lot of liquidity that was created over the last 10, 20 years. We have a lot of money out there, and we have a lot of good stories. And that is a really good combination for higher security prices. But I think that, and I'm going to get into this in a minute, a lot of the hype is being undermined by the realities of these businesses. So there's a pretty good paper that I'm going to from this, I think it's called GQC Associates. They did a good research paper on this. I found them through Jesse Felder's weekly email. I read it. It's really good because it goes back to the .com era and compares some of it actually has like one of the Payne Weber uh, client, communications talking about what stocks to buy, like Cisco, and the themes for why these stocks should go higher, which was issued right before them. It's really good. It really goes in depth about the actual businesses, how they were overvalued, um, talks about the telecom bubble, the .com bubble, and makes the comparisons to today. So here's a few snippets from that paper. I'll put a link to it in the show notes. It's really interesting. I'll put it in the weekly free email this week, also the Actionable Intelligence Alert free weekly email I send out. I'm going to reread it again this weekend when I have more time, but it's really outstanding. It really explains this very well. But here's a few snippets. Even in the internet era, the biggest winners only became apparent many years after the bubble burst, e.g., Meta, Google. As a result, we believe investors are not adequately pricing in the risk of disruption. Google's dominance in search is being challenged by AI advancements like ChatGPT, while software's once sticky dynamics are facing erosion, as seen in Adobe's sharp derating from 50 times to 15 times earnings per share, despite robust earnings growth. These shifts highlight how quickly market narratives can unravel. So it goes on. The third pillar of the big tech thesis during the 2010s was hyperscalability. Unlike most industries, big tech grew rapidly without requiring much incremental investment. This is very important to understand, folks, allowing them to generate substantial free cash flow. For example, Google raised up to 50 million from inception through its IPO, a figure that would be unimaginable today. Similarly, Meta essentially required no incremental investment for each newest subscriber. This argument no longer holds true in the AI era. This is exactly what I and other people have been saying, that this is different. Basically, these internet companies like Google, Meta, they didn't have to spend a lot of money to grow and to get free cash flow. Now they're getting into having to spend hundreds of billions of dollars physical assets that depreciate very quickly, and there's no free cash flow coming. Okay? This is a problem. They're not the same businesses that they were 5 years ago or 10 years ago, where they were high margin businesses. Not only are they going to have to, if they continue down the road, are they going to have to spend hundreds of billions of dollars on these AI data centers? They're going to have to get involved with power production because it's just happening too slow. So now they're going to be in the utility business, not a high margin business. Goes on, give other examples of times where we had bubbles and what happens to cash flow. Big tech capex as a percentage of EBITDA is now running at 50 to 70%, which is similar to AT&T's 72% at the peak of the 2000 telecom bubble and Exxon's 65% at the peak of the 2014 energy bubble. Historically, companies experiencing higher capital intensity tend to be structurally poor investments. In other words, AI capex has already caught up to prior bubble levels, even after adjusting for big tech's initial high margins. So their margins are being eroded. It's being masked somewhat by the depreciation of that they go through. And people don't understand accounting. I'm not going to get into it. You should read the paper. It really gets into this. Murray Stahl was talking about this at Horizon Kinetics a couple years ago, okay, that this was going to, that the valuations in these companies were going to get eroded because they have turned now from high margin, low capital intensity businesses to or from higher margin, low capital intensive businesses to lower margin, high capital. Okay. So their business model has reversed, and many people haven't noticed that because the assumption is that AI is going to lead to all of these miraculous changes and create all this productivity and all these profits. Well, this is the same argument that was made during the dot-com bubble. Same argument that was made during the shale bubble. Drill, baby, drill. Okay, and I think this is the money shot comment. Historically, companies experiencing higher capital intensity tend to be structurally poor investments. I agree. But yet the AI boom continues to advance. Here's from U.S. Global Investors. You know, I love their charts. Frank Trotter puts out those excellent, I think it's his name, No, Frank, what's his name? Not Trotter. Anyways, usglobalinvestors.com. Excellent charts. Frank Talks is the name of the thing that comes out every month. But anyways, here's the AI boom has added 8 trillion to tech giants market cap since ChatGPT's launch. So there you go. Okay. how much of this, how many people understand that the business models have changed at all these companies? I think I read in the article that Oracle is spending over 100% of cash flow for all these build outs they're doing. And they're now a new competitor to come into this space that was dominated by, you know, AWS, Microsoft, Google, so this is what happens. All this capacity comes online, and what's interesting, and it drives down any prices that they probably could have charged. And again, it was the same argument that was made during the dot-com bubble. It's going to spend billions and billions of dollars on all this fiber that we're going to run out and put in the ground. And people, if you build it, they will come mentality. Not a good business model. And it's going gangbusters. I mean, this is a Reuters article from last week. I don't have the whole article. I'm just giving you the headline. But it's basically $40 billion in data center construction just in June alone. Highest number ever. It says U.S. data center build hits record as AI demand surges, Bank of America Institute says. And so it's going. It's going to keep going till it can't go anymore. And so here's another chart from U.S. global investors. Of course, we all have been talking about the power demands. I've told people to beware of the CAGR, compound annual growth rate, because this is what people make mistakes and extrapolate out into the future. Okay. So this is why, people have asked, I mentioned companies like GE Verona that builds gas turbines. Would I invest in the company? No, it's extremely overvalued, even though their business is going gangbusters. If I worked there, yeah, I'm sure they're getting big bonuses and, you know, big raises and everything's working out fine, but doesn't make it a good investment. It's a good business. They're in an excellent business building these gas turbines. But I saw the same build out when they deregulated electricity prices in the late 90s, early 2000s, and a lot of these merchant plants were built, um, you know, and they couldn't make money. They couldn't, and they ended up going bankrupt. There was a bunch of these companies out there. Okay, I can't even remember their names now. So you have to beware. Whenever I see these Kager things going straight from the lower left to the upper right, I get nervous because who can actually extrapolate and understand what's going to happen in the future? Okay, so we'll have to see what happens, but you know, again, this is all part of a bubble in my view. So here's a tweet. I didn't put the video, but there's a video of Zuckerberg being interviewed. He was with the president. They had that tech conference maybe a couple weeks ago, and Zuckerberg was quoted as saying that Meta intends to spend over $600 billion by 600 billion dollars by 2028. And he says it in the video. He tries to explain why they're doing it. There's a lot of ums and uhs. And basically, it's what other people have said. All of these companies are on a kamikaze mission because they have determined, and their boards and their managements have determined that the risk, as Zuckerberg says here, this is why I quoted him at the top of the slide, the risk is in not being aggressive enough. If this all turns into, as he says, AI superintelligence, and you're 2 years late or you're not aggressive enough, you're going to get left behind. I don't believe that. I believe this was nothing more. Yes, AI is very useful. AI is very helpful. AI will lead to productivity gains. AI will lead to all kinds of things that we can't imagine. Uh, and people will make money from it. But are the initial pioneers going to be the ones that make money? Go back and look at the dot-com bubble. That's not how it worked. Okay. So we don't know. Maybe all of these guys are right. Maybe I'm wrong. I'm trying to be consistent with history and showing that you can recognize when there's a bubble and that pioneers that go into the wilderness usually get arrows in their back. So what does he say? We are going to spend aggressively, even if we lose a couple hundred billion. It would suck, but it's better than being behind the race for super intelligence. To even hear Zucks say this, it shows how important they believe the opportunity is. CapEx is not slowing down. And so what's that going to do to cash flows? What's that going to do to earnings? Once you put the stuff in the ground, you have to buy the next. When NVIDIA comes out with a faster chip, you have to buy it. Because if you don't buy it and your competitor does, you're going to be behind. So it's a never-ending cycle of CapEx. And we know that there's been no returns to this point. The same thing we saw in shale. Drill, baby, drill for the sake of drilling, because the incentive was to drill, because that's what the boards had structured the management's incentives to do. These people have convinced themselves that they're in a race for super intelligence and they need to spend hundreds of billions of dollars on depreciating assets. This is, again, this is something that their business models weren't capitally intensive just a few years ago. Now they are. Their whole business has changed. And that's not reflected. That risk, in my view, is not reflected in their market caps. And so we'll see what happens. Maybe I'm wrong and maybe they're right. We'll see. I don't, unless you can start making money off this, you're going to be in a big problem. And eventually it's going to hit a wall. It's a big, fat, greasy bug looking for a windshield, in my view. So this is the kind of demand that I'm actually interested in, which is real electricity demand. So this is showing from IEA and what's really going on in the Middle East and North Africa. The explosive growth of electricity consumption in the Middle East and Africa. I'm more interested in what's happening in the global South and East, just in regular consumption trends as billions of people enter the middle class. And you can see the electricity demand and demand growth by end user, basically from just 25 years ago, 500 terawatts up to now, it's tripled, okay, in well, till 2023. And this just shows you the demand, space cooling, appliances. You can see that over here. Um, Energy intensive industry. So this will continue. This is just the Mideast and Africa. This isn't showing you all of Southeast Asia and India and sub-Saharan Africa. So this is where I think people need to focus when they want to focus on energy demand. This is what's really going to push it. Yes, this stuff happening with AI is really aggressive, but I don't think that that will be the big push for the long term. I think most of the growth is going, this is kind of instructive of what happens as people get wealthier and wealthier and their consumption patterns increase. They want appliances, they want air conditioning. Can you imagine living in the Middle East, living in Saudi or one of these places and not have air conditioning? That's mind-boggling. So I'll put this article in there. It's just a short article on investing.com. I think Trump admin pushes for uranium stockpile. One of the things that I'm interested in, and I've talked about in the past in prior videos and in some of my writing, is the fact that one of the things I like about the Trump administration is the trying to reverse all of the neglect that we've had in this basic materials that are needed to reindustrialize and to try to keep the United States on top. So, as far as economically, militarily, I don't think it's going to work. But again, we're in this to make money. So we're looking at the Trump administration is going to push for state intervention, and that means money and political political push behind certain industries, then it might behoove us to front run that and get in front of it before they give the money. We saw what happened just recently with the Defense Department investing into MP materials, the rare earth miner that's gotten a big influx where they set a minimum floor price to incentivize this company to go out and mine, plus giving them money, plus doing everything at the federal government level to remove barriers to the development of their project. I think the same thing's going to happen, as you've seen, same thing's going to happen with other critical materials. And they've identified what these critical materials are. One of them is uranium. In order to have this big push, and I think, Secretary Wright at the Energy Department gets this, and I think he's behind the scenes pushing a lot of this, and people in the Energy Department, people in the administration get it. We have to go nuclear. And so they kind of took a look at it and said, wait a minute, 20% of our base load electricity is generated by um, nuclear power, and we don't produce hardly any homegrown uranium. We have to still import quite a bit of uranium, enriched uranium from Russia, which, we're somehow having a war with, a proxy war in Ukraine. That doesn't make sense. How is that? It's a national security issue. And so if they're going to throw money at this, what does that mean? So here's the article, a few snippets. Secretary of Energy Chris Wright told Bloomberg on Monday, September 15th, that the Trump administration is determined to reduce U.S. dependence on Russian enriched uranium. It still accounts for about a quarter of the fuel used in America's 94 nuclear reactors, which generate roughly 20% of the nation's electricity. Quote, we're moving to a place, we're not there yet, we no longer use Russian enriched uranium, unquote. We hope to see rapid growth in uranium consumption in the U.S. from both large reactors and small modular reactors. The size of that right buffer would grow with time. We need a lot of domestic uranium and enrichment capacity, unquote. It goes on here. While the U.S. once dominated nuclear technology, years of underinvestment left fuel production concentrated in Russia and to a lesser degree Europe. Officials now see that dependence as a strategic liability at a time when energy security is increasingly bound up with geopolitical rivalry, something we've been saying here for years. So we finally have an administration that gets it. It's obvious to me they're going to pump a lot of money into this. So you got to get ahead of it. So you figure out where the administration and the government's going to. Do I agree with industrial policy? It doesn't matter what I think politically or philosophically. That's what they're going to do. I suspect that they're going to spend a lot of money trying to pump up, even during the first Trump administration and the Biden administration, they created some incentive for new uranium mining. It wasn't significant enough to move the needle, but why couldn't they put a floor under the uranium price, say $120 a pound? You think that that would incentivize people to go out and mine? I think it would. Will they do it? I don't know what they're going to do, but I think, they're going to throw money at it and they're going to do what they can to remove barriers to produce more of these, what they consider critical material. It's unconscionable, folks, that we have 20% of the nation's electricity being generated by nuclear power, and we're not able to produce very little uranium here and still buying 25% of our enriched uranium from Russia. It doesn't make any sense. Now, I don't, you know, that's crazy. That is a national security issue and a geopolitical issue. They're going to try to fix that and they're going to throw money at it and incentivize it. So I think that that's going to be an impetus. You're going to see, the administration's only been in there 6 months, 7, 8 months. Okay. I think you're going to see more and more of these interventions into the market, whether I like it or not, doesn't matter. But, you saw what they did with rare earths. They probably do the same thing with uranium. He also said the U.S. plans a $5 billion critical minerals fund to bolster supply security. Again, go look at the critical materials list, and all of these things that you're familiar with are on there. They're going to incentivize it. So the United States government is in advanced talks to establish a $5 billion investment vehicle aimed at securing critical minerals, marking Washington's largest ever venture into strategic mineral deal making. The proposed fund would be structured as a joint venture between the U.S. International Development Finance Corp, DFC, and New York-based investment firm Orion Resource Partners, with each contributing up to $2.5 billion. Funding would scale over time, positioning the initiative as the DFC's biggest commitment in its history, according to the government data. Officials say the initiative underscores a recognition that mineral security is now a strategic imperative, both for the energy transition and for safeguarding U.S. national security interests. When they tell you what they're going to do, you should get in front of it. This is how a tremendous amount of money can be made. Five billion's nothing really. I mean, that's one large copper mine. Get it up and running. $5 billion. But I think that, you get it up and running, then it expands over time. Okay. And this also plays to what Trump believes in. He wants to bring mining back here. He wants to bring high-paying jobs here. He wants to bring development back to the U.S. As I've said before, I wrote an article for the Actionable Intelligence Alert newsletter. I don't even know when it was, several months ago, 6 months ago, cataloging the tremendous mineral wealth that is just here in the United States. And I didn't even get into Canada and Mexico, just in the North American continent, if you will. Trillions and trillions of dollars, but it hasn't been exploited because of, political will again. It's all comes down to political will. And so he's going to get that going because it produces the minerals here in the US. So it solves a geopolitical issue, strategic minerals, high paying jobs, all of that stuff. So hopefully it won't be contaminated with all kinds of, you know, I saw something similar in the renewable business when they had the stealth Green New Deal during the Biden administration, all these stupid requirements that you had to go through, create an apprenticeship program, DEI requirements. Just give the people the money and get out of the way, and they'll people know what they're doing. But hopefully it won't be contaminated with all of this government nonsense, which typically any kind of money from the government typically is, but we'll see. And so here's a good chart. It was in Crisis Investing. It's Doug Casey's outfit. I don't know if he's still affiliated with it, but anyways, it shows mining industry. The world is sleepwalking into the biggest resource bull market of our lives. This is what I believe. It's not necessarily going to be demand focus. It's going to be, in my view, lack of supply. And you see the mining industry as a percentage of global equities. Mining share of global equities has fallen to levels not seen in over a century. So you see that up until basically 1970, um, mining as a percentage of global equities was somewhere between 6 and 11%. Now it's down to 1%. I think this is going to change. This is going to reverse. It's going to be multi-year. Took a multi-year decline. It's going to be a tailwind. The tailwind of lack of investment, lack of interest, and now again, continuing upward demand, lower grades, exhaustion of mines and oil fields, and all of these things that are extractive industries that have been ignored for several decades as the West in particular and the world in general financialized its economies. And so we're going to have to go back to actually building things, mining, farming, making things. Okay. Not sitting in a cubicle on the 20th floor with computer screens pushing buttons. Yes, that will still exist, but in order to have all of that, there are materials that you need. This is what we've been talking about at Actionable Intelligence. I think this is an outstanding visual that kind of shows you what's going to happen. Okay, shows you the opportunity. Do we go back to 11%? I don't know. Can we go to 5%? That would be a tremendous change and amazing amount of wealth creation. So this is pretty good. This is what I've been saying. Occasionally I run anything. This is from the AIA September 16th. Here on the left, you have the average annual conventional oil and gas discoveries by decade from 1960 to 2024. It's what I've said all along. You're finding less and less new oil, okay? Unconventional oil and gas discoveries because the easy onshore stuff, conventional stuff, has been found. And shale, is unconventional, so it's not reflected in this. And so it made up the difference, basically these 2 decades. You're using now 104 to 105 million barrels a day. You're using 36 to 37 billion barrels a day. You're not finding that. You haven't found 30 billion barrels of oil in a year in conventional resources since 2 decades ago. And you've had tremendous underinvestment. You've had a lot of castigation of the oil industry through climate nonsense, through these nonsensical ideas from the IEA and the global thought leaders that demand was going to go away, that we were going to go into this renewable utopia. EVs, all this nonsense. And now that's all of a sudden been shed again. Another fantasy that's crumbled. You look at the chart on the right, and I'll put these charts up on the Actionable Intelligence Alert uh, Facebook page because I go through these on the slides very quickly. You can go back and look at them on become a sign up over there. You can see these things. I put them up. You can look at them at your leisure, download them. But not only are we finding less conventional, it's taking longer. You can see from the decade of 1990s, the time to exploration award to startup was slightly less than 15 years. Now it's slightly less than 20 years. So you're finding less and it's taking longer. So what's the opportunity? Well, all the easy stuff onshore has been found offshore. And what I love about offshore so much is that because it was the offshore oil and gas services business, drilling businesses has atrophied so much, consolidated down so much into just a few players. Like in some sectors, you only have 3 or 4 players, or in some sectors, 2 or 3 players. That when investment returns, which inevitably new investment will have to be made at higher levels, I think it's estimated that you have to spend $540 billion per year just to maintain current production. That doesn't even get into uh, new production, new reserves that have to be found. And you're going to have to go into areas that are more complicated, i.e. offshore. And so the amount of companies that exist to do that, the expertise has shrunk considerably. And so if you get this wall of investment, which I'm forecasting is going to happen, we've already seen it in a lot of the subsea services companies, service companies. People say, well, haven't made money in offshore. Well, people immediately think about offshore. They think about only the 4 or 5 offshore drilling companies, which actually their businesses have turned around. But there's other businesses that are involved in this. There's vessels that service the rigs. There's subsea construction companies and engineering companies. There are companies that make equipment that are used. Okay. And you're at tremendous depths and pressures. This is highly engineered, highly skilled, highly crafted with top-notch materials. Only a few companies can do these things. And if you look at their backlogs and their businesses, they're doing tremendously. In fact, they're generating so much cash, some of these companies, which I have a couple of them in the portfolio, they don't know what to do with all the cash. And so they do, the old Walter Schloss methodology. What can I do with my cash? Pay down debt. When I do that to a sufficient level, what do I do now? Well, then I start buying back stock and paying dividends. And I've had tremendous, returns on some of these companies, and that's going to even get better in my view. Where else are you going to go? If you acknowledge, this is a major what happened just recently with the IEA basically saying, well, we're not going to have peak demand till 2050 now. That's a big deal because OPEC's been saying that for a lot. People say, well, that's OPEC. They just say that because they're in the oil business. Well, who would know more about this than them? And they have been saying for years this underinvestment is going to lead to materially higher prices. And that's what we're going to need in order to bring the hundreds of billions, if not trillions of dollars in investment we need. Some companies, I think, are looking forward. You're seeing a lot more of the IOCs, the international oil companies, BP, Total, Petrobras. They are still investing offshore because they're not necessarily looking at the price today. They're looking at, I have to maintain my reserves. Where else am I going to go? I need to be doing these projects. Are they drawing them out further sometimes? Yeah. Are they going slowly but surely? Yes. But at some point, we're going to see new all-time inflation-adjusted oil prices, in my view. That's going to be well over $200 a barrel at some point. This is another reason why I love Canadian oil sands companies, CNQ, Suncor, SU, Savonis, Cenovus, Imperial Oil. Why? They've already made their investments. They're just ATMs now. I think I showed a chart probably several months ago where somebody had calculated the amount of free cash flow that these companies have. Cumulatively, it was something in the order of like $50 billion a year, yet their maintenance capital is capped that they needed to keep the operations running were half that. And so they were, even at these considered low oil prices, these companies, which can make oil profitably down into the low 40s, we're still having significant cash flows. And what are they doing with the cash flows? Paying down debt, buying back stock, paying dividends. And if we're going to get into this secular trend, which I believe is going to happen over the next decade, where energy prices are going to go up because they need to incentivize new production, they've already made the investments. None of the oil sands operators are talking about making billions of dollars of investments. They're just sitting there. Keep the thing running, do the maintenance, collect the cash. It's a broken slot machine in my view. Now, the problem is people think, well, the oil price is low, so it's low yesterday, it's low today relatively, so it'll be low tomorrow. Well, I don't believe that's what you should be looking at. I should be looking at things that are undervalued and understanding these charts. You can't find for 20 years less than you're consuming. You're consuming 30 billion plus barrels of oil a year and not finding that. You're only finding, the last decade, 2010 to 2019, you weren't even finding 20 billion, right around 20 billion. You were net negative replacement of 10 billion barrels. And now it's even worse. So this is going to matter at some point. If I can own the crown jewels at historic, remember, oil's at 62 WTI, 64, 65 Brent, whatever it is. Inflation adjusted, this is like $40 barrel oil. This is cheap. Energy is really cheap now. So the beginning of the end of the peak demand fantasy, here's the OPEC comments last week. A cautionary tale, the IEA now calls for more investment in oil. So I'll put this up on the Facebook page for your review. Here it is. The fantasy's over. And the zeitgeist is now changing. Remember how we had peak ESG and that changed? We had peak, the zeitgeist changed on nuclear. Now the zeitgeist is changing on oil and gas. We've been way ahead of these trends. This is why we continue to beat the S&P. We look at things rationally as we can, unbiased. Yes, do I make flippant comments? Am I sarcastic? Because it deserves that. All of these so-called brainiacs, PhDs, these are all captured interests. Okay, these are all captured interests that advocate for a policy that's not based in reality. So what does it say? Today, the IAA published a report entitled The Implications of Oil and Gas Field Decline Rates that states, quote, if current levels of production are to be maintained, over 45 million barrels per day of oil and around 2,000 billion cubic meters of natural gas would be needed in 2050 from new conventional fields. Well, I just showed you that we're not finding it, and it's taking longer. The IEA's report also refers to factors that have discouraged oil industry investments, stating, quote, market developments also influence oil and gas activities. For example, related to the shale revolution in the United States, the oil price crashes of 2014, 2015, and 2020, as well as uncertainty about long-term oil demand, have discouraged investment in the exploration and development of new large, long lead time conventional hydrocarbon projects, unquote. However, the IEA has not referenced how its own advocacy of its net zero scenario or its own prognosis of peak oil demand have discouraged investments and contributed to uncertainty about long-term oil demand. Yeah, they're not going to do that. They're a captured globalist entity, the IEA. They were advocating for renewables, advocating for peak demand because they were part of the establishment killing for these interests. They were not an independent agency. You don't become the head of the IEA, International Energy Agency, because you're an oil and gas guy. You go there, they tell you what to say, you say it, they give you money. And then you get to sit on stages and get interviewed by Bloomberg and CNBC with your legs crossed and your mineral water, and everybody's sitting there listening to you like you're somebody that knows what you're talking about. That's how ridiculous this is. And people make investment decisions based on this. Goes on. In May 2021, the executive director of the IEA told The Guardian, which is a British newspaper, left wing, quote, If governments are serious about the climate crisis, there can be no investments in oil, gas, and coal from now, from this year, unquote. This is the International Energy Agency. I remember when he said that. This is what he said. So of course, this permeates back into banking, insurance. So what did the banks say? We're not going to fund. Remember, we talked about this several years ago. Remember, I brought this up. I showed you how stupid and ridiculous it was. We're not going to make loans for new oil and gas projects. Forget about a coal mine. That's not ever going to get built again in the West. We're not going to insure these projects. And so they were squeezing the noose, the globalists, because the agenda was climate change and renewables. At today's launch of its new report, the executive director stated, quote, an absence of upstream investment would remove the equivalent of Brazil and Norway's combined production each year from the global marketplace. The situation means that the industry has to run much faster just to stand still, unquote. So within 4 years, the zeitgeist has completely changed. In contrast to the IEA's U-turning on this important issue, OPEC has consistently advocated for timely investments in the oil industry to account for decline rates and meet growing demand. It is vital that all stakeholders are consistent in recognizing this and do not return to rhetoric that there should be no investment in new oil projects. Well, you can make the argument, well, that's just OPEC. Their only revenue in these countries is oil. Of course, they're going to advocate. I'm just showing you what reality is. And the IEA itself has now admitted oil and gas demand is going to continue to grow for decades. Therefore, if you don't invest massive amounts of money, there's going to be supply problems, and that's going to manifest as tremendously higher prices. But that is what is required in order to get the higher investment, and it's going to happen. Position accordingly. So here's Josh Young. I think he was, there's an article in New York, I think it was New York Times, or it was a Reuters article. He was quoted. Um, he's been right about all this stuff too. He's a little bit more, shall we say, balanced in how he reports things. He's not a sarcastic guy. He's really chooses his words a lot better than I do. But he's been way ahead of this also. So, anyways, here in California, which is a very large hydrocarbon blessed with hydrocarbons, it probably has the same amount or more oil and gas than Texas has. They just have been politically constrained in developing it. I think I read an article. I might have read this article. I can't remember. If I remember correctly, and I have to check this, so maybe I'll probably check it afterwards. But I think Kern County, California is a big oil and gas area of California. I think only like 50 permits were granted last year for drilling new wells. And now they want to issue thousands of permits in California. Why is that? Well, Mr. Newsom plans on being the Democratic candidate for president in 2028. And if you look at the gasoline and energy prices in California, because of the nuttiness that goes on there, the politics that goes on there, they've restricted, we know the story. And so he's trying to cover one of his flanks now because he knows quite well that there's plenty of oil and gas there. Okay. And so he doesn't want JD Vance standing up there during a debate and saying, well, you're bringing 200 tankers a year from the Middle East and all over the world from our enemies in unstable areas when you have billions of barrels of oil sitting right in California. And you want to bring this same stupid policies to the nation. So he's trying to get ahead of this. He's a good politician. I give him that. He's a good looking guy. He knows how to BS. So you shouldn't just dissuade this guy. And as I put here, it's always about power and money. It's the same thing. If you remember back in 2008 when oil prices got to $145 a barrel, even Nancy Pelosi was suggesting that drilling offshore California probably, might be a good idea because it's always about politics and power. And inevitably, the politics and power lead to free money for these people. So that's what they're all interested in. And so he's not going to stand up there. I mean, I have to give the guy credit that he's at least a good politician and not a whack job like a lot of these people out there. Okay. So here's a few snippets from the article. It says California lawmakers, this is last week, passed a bill over the weekend that would allow the construction of thousands of new oil wells annually in the Golden State in a bid to make oil supply more affordable for refineries and keep fuel prices in check for consumers. Now, they had the opportunity to do this for decades. Why didn't they do it? Why didn't they do it? That's the question you have to ask. So they only respond for politics, or do they do what's right? Look at the jobs that would be created by reinvigorating the California oil industry. If you look at the history of the oil industry, uh, watch that movie. What's it called? There Will Be Blood, whatever it's called, about the oil industry. That guy Daniel Day-Lewis. I mean, that's all based in California. It was a tremendous boom out there. And then these guys stifled it because of the environmental wackoism. I mean, one of the companies that I'm interested in watching the circus that goes on with Sable Offshore, trying to bring online these oil platforms that are off the coast of Santa Barbara, former Exxon assets. I've kind of been following that saga and how they're throwing everything against the wall to stop that thing from coming back online, which that company could very easily ramp up oil production to 40, 50, 80,000 barrels a day over a year or so. It'd be a tremendous cash flow machine. So we'll see what happens. But it goes on here on the right side here. Continues a snippet from the article. Few issues are more politically sensitive than gas prices at the pump. And with Governor Newsom widely expected to run for president in 2028, rising pump prices and declining in-state production have suddenly become top of mind concerns, said Josh Young, Chief Investment Officer at Bison Interests. In response, his administration is advancing a significant policy shift aimed at streamlining new well approvals and increasing local output. Well, at least it will possibly create some opportunities. We'll see what happens. I'm just trying to tell you the cynicism I have towards these politicians. That oil was always there, billions of barrels of oil and natural gas, and, paying way more than the rest of the country, putting onerous regulations and closing refineries. And finally, it's like, well, I want to run for president. That's a big hole on my left side flank. I better close that hole up. I've got 3.5 years. Now we can go back and say, well, you're attacking me for higher energy price, but look what we did. We've given thousands of permits. Our oil production's gone up. We're doing everything we can. You know, no one will talk about what they did before that or what was the impetus for that happening. So, like I said before, I never met a politician that wasn't a bum. So I wanted to show this, and senior gold miners are now have the most overbought RSI momentum. It's relative strength momentum reading of all time. This goes back to at least '07. Okay. This doesn't go back forever, but you can see when RSI gets extremely overbought on the GDX senior gold miners, um, when you get to these high RSI readings, usually indicates a multi-year top. Okay. We now have the most overbought based on RSI for the GDX of all time. And so people are going to say, well, John, you said you're bullish on gold. I am. What if I give you the scenario though? You say, well, you said China's buying that gold's being remonetized. They are. It is. What did I just talk about for the last 15 minutes? How I think energy prices are going higher. What if oil goes on a 3-year, 5-year run and eventually makes a new all-time high? What does that do to these huge super uh, gold mining company profits? Remember, 40% or so of their energy input, of their costs are energy. And if energy doubles or triples in price over a couple year period, what's that do to their earnings? What would that do to their stock prices? So I think you could have a situation where, yes, um, the fiscal situation of the world and the US in particular is negative and bullish for gold itself. But that doesn't necessarily mean if costs go up. We've been very fortunate. It's been uh, with gold mining, it's been a very unique period of time where the gold price has went up massively, and yet their costs their costs have still went up. If you look at the all-in sustaining costs, but energy prices, which are the major input price or one of the major input prices, has not. Okay. And I think that that could change. If you look at ratios, you could see, the gold to oil ratio and things like that. Do I think we could be in a situation where we get higher oil prices, you know, and that causes earnings to drop? Yes. And the stock prices would pull back. And then I think you could have a multi-year pullback like you saw between 2016 and 2020, and then another ramp up in or between 2016 or the top in like April, May 2016, the low right before in October of 2019, and then start ramping again. You could be in that situation. It would be interesting to take this and put the oil price on top of it. What happened during that time, the oil gold to oil ratio. I might even go through that exercise. Uh, it might be instructive. But I think you could be in a situation. This is why I haven't been and people are so bullish on gold mining now. Everybody's out there. Everybody's investing in junior. I've really trimmed back in the portfolio a lot of the gold mining stocks. Because they have went perpendicular. Um, went straight up, I mean. So uh, I would be cautious. That doesn't mean they won't keep going up. That doesn't mean I'm negative on the gold price. What it means is that I think the costs for these companies could shift. Their all-in sustaining costs, their cost to mine gold could go up significantly, thereby contracting margins and thereby their cash flows and profits. And then people would, that would necessarily flow into the share prices, in my view. So you could have a multi-year pullback in the mining stock prices, and then, as energy, this is typically what we see in bull markets. Gold moves first in these resource bull markets. Copper moves. This is another thing I'm bullish on. Copper then moves, and then energy moves. Okay. Um, I'm very bullish on copper and platinum group metals now. And I think I found a good company that is well positioned for both of those. And I think that those have underperformed relative to gold. So you may want to take a look at them instead of, jumping on what everybody else is jumping on. Gold mining shares are a shiny object right now. And people are just, gaga and have lost their minds. This kind of chart pattern is what you see in a lot of the tech stocks. So buyer beware. Again, history doesn't mean that a multi-decade, a multi, through the end of the decade, we won't see higher gold mining shares. I believe we will have a blow off top. I do not believe this is the top, but I do think we could have a big pullback and consolidation, and that could be consistent with energy prices moving up, pressuring their margins. And then again, another move higher several years down the road into a blow off top as the fiscal situation in the U.S. continues to deteriorate and you get into full blown yield curve control and all that stuff. So I just caution people to beware. All right, guys, that's it for this week. Appreciate your viewership. I hope that you are getting something out of this stuff. Please take advantage of the offerings we have at Substack for the free weekly newsletter. I put a lot of articles, podcasts, interviews, what have you. I also write sometimes a short commentary on things. I don't get into specific companies, obviously, but I talk about these themes and more in depth. And I also have the paid product, which is the Actionable Intelligence Alert newsletter, where we look for undervalued securities around the world and look to compound wealth over time. And the classic Aesop's fable of the tortoise and the hare. We are the tortoise that just wants to make positive progress consistently over time. All right, guys, that's it for this week. We'll talk to you next week. Thank you.